Hello friends, my name is Shanti Dugar. In this video, I will cover the concept of capital budgeting and the traditional methods of capital budgeting, which is payback period and average rate of return. So the video will cover basically the meaning of capital budgeting, what are the evaluation techniques of capital budgeting, and traditional methods of capital budgeting such as payback period method and average rate of method will be covered in this video, and the discounted cash flow methods will be covered in another videos. What is capital budgeting? Capital budgeting is the process of planning and evaluating and allocating financial resources for capital investments in fixed assets or new projects for future growth of the company's business. So whenever any projects or new investment proposal comes, the role of finance department is to evaluate the project, its economics, its return profile, and suggest to the top management whether the project is worth pursuing or not. So that is the process and technique called capital budgeting. So this investment proposal could be on mega projects such as greenfield projects or a brownfield expansion, or it could be smaller investments like buying of any equipment or debottlenecking of certain plant and machineries, or some energy savings schemes or some cost reduction schemes whereby some investment is required in fixed assets and the management has to evaluate whether these investments are generating adequate returns or not. So that process of evaluation is called capital budgeting. So there are broadly two types of techniques we can classify for capital budgeting. The first is the traditional techniques, which is payback period method and average rate of return method. And the second one is the time adjusted methods, or we also call them as discounted cash flow method, DCF method. Under DCF method, there are three types of techniques. First is the NPV, net present value method. The second is IRR, which is internal rate of return method. And the third one is profitability index. So we will explain it one by one. So first, understand the payback period method. Payback period is the time required to recover the investment made in the project. So whatever investment we are making at the beginning of the period of the project, how much times it takes to recover that investment is basically the payback period. So in other words, we can say it simply measures the estimated cumulative time required to generate the equivalent amount of cash flow from which was initially invested in the project. So simply we can calculate it. First, we have to calculate the each year's net cash flow. And when I say net cash flow means cash flow for year one is equal to cash outflow which we made at the beginning of the year. Then the return generated out of that investment is the cash inflow in the subsequent years. And then we take a cumulative cash flow year on year basis. So the first year cash flow is added to the second year cash flow, so that becomes 2 years cumulative cash flow, and then it is added with third year cash flow, so that becomes 3 years cumulative cash flow, like that. And whatever is the accumulated cash flow until it reaches to a positive number, that year is the payback year. So I will explain this in one simple example, but simply we can also calculate the exact payback period by putting this formula: amount to be invested or amount invested at the beginning of the project period divided by the estimated annual net cash flow. So that will give the number of years it takes to recover that initial investment. It can also be calculated by using this mathematical formula, which says that payback period is NP minus 1, where P minus 1 is the number of years after the initial investment at which the last negative value of the cumulative cash flow occurs. So up to this period, the cumulative cash flow still remains negative. So that is the last year in which the negative is there. So that is number of years, plus we have to then take the cumulative cash flow for the period P minus 1. So which is the value of cumulative cash flow at which the last negative value of the cumulative cash flow occurs, and that is multiplied by -1. So this is the negative value. If you multiply by -1, so it becomes positive, and that is divided by the CFP. CFP is basically the value of cash flow at which the first positive value of cumulative cash flow occurs. So let's understand this with a simple example. Here, suppose you are investing $500 million at the beginning of year 1, or let's say year 0, and the cash flow generated out of that is 50 in first year, 80 in second year, third year is 100, fourth year is 120, and like that. So cumulative cash flow for the first year, after first year, it becomes 450, that is minus 500 plus 50. So still cash flow is negative by 450 million. Second year cash flow is positive 80, so cumulative becomes minus 370. So like that, to minus 270, minus 150, minus 40, and here it becomes positive $80 million cumulatively. So we can say that the payback period is between after fifth year but before sixth year completion. So when we have to calculate using that formula, we say NP minus 1 is 5, because till 5 years after the initial investment, cumulative cash flow remains negative. So up to here, the cash flow is negative. So 5 is the NP minus 1 value. Then cumulative cash flow of P minus 1. So of this year, the cumulative cash flow is still minus 40. So that is taken as the numerator, and that is multiplied by -1, so it becomes positive. So basically you have to recover another $40 million in the next year. So CFP is 80, CFP is 120 actually, not 80, sorry here. So 40 we have to recover out of 120. So 120 was recovered in the whole of year 6. So to recover 40 we need 0.33 years basically. So payback period becomes 5.33 years. How payback has limitations and how it has some usage in the business. So payback does not take into consideration the time value of money. This is the biggest limitation of payback period. However, this limitation can be overcome if we calculate the discounted payback period. Discounted, I mean, whatever is the cash flow for the future period, if you discount it to bring it to the present value terms, and then you take a cumulative present value, and at whatever year the cumulative discounted value of the future cash flow becomes equal to the amount of investment, that becomes the discounted payback period. So these limitations can be overcome easily by adjusting the formula or methodology of the calculation of payback period. The second limitation of payback period method is that it ignores the cash flow beyond the payback period. So most of the major capital expenditure like mega size projects have a huge cash inflow after the payback period is over, because they have a long lifespan. So they continue to earn returns after the payback period is over. So payback period method completely ignores that cash flows post payback period. The third limitation is that it calculates only the soonest payback period. That means the first period after which the investment has paid for itself. If the cumulative cash flow drops to negative value after the payback period, it completely ignores that. So that time this formula cannot be applied. So once the cumulative cash flow has become positive, payback period just stops at that point. So if after that period, if cash flow becomes negative for some reason, or forecast of the cash flow becomes negative, payback period does not consider that calculations in its formula. Additional complexity arises when from year 0 to year in which cash flow becomes positive, if there are sometimes negative, sometimes positive cash flow, that time it creates problem how to calculate the payback period. So there is a modified approach to that, which says that we can use the payback period algorithm. By algorithm means that first you sum all the negative values, negative cash flows values, and take a sum of that, and then you take sum of all positive cash flows, and then determine in which year the cumulative positive cash flow becomes equal to the cumulative negative cash flows. That is the period when the payback period is said to return the original investment or cumulative investment in the project. So that is a way around it. Now the last limitations is that this method is mainly used to calculate the short-term profitability or the projects where the value of investment is very low, because it overlooks the cash flows arising after the payback period is attained. So we can say this has a limitations, but it is very simple method of evaluating projects and very useful to calculate the smaller value of capital investment proposals. Now let's go to the next method of project evaluation technique, which is called average rate of return technique. So average rate of return is a very simple measure to evaluate the average return in percentage terms on the investments made by the company in a project over its life. So this can be calculated very easily, that average yearly net profit after tax over the life of the project is the numerator, which is to be divided by the average investment made over the life of the project. So this is very simple accounting profit, net profit after tax divided by the total investment over the life of the project on an average. So this method also has some limitations, like it does not take into consideration the time value of money. So if the investments are made at the beginning of the year, beginning of the project life, or if investments are made at the end of the project life, it does not take into consideration the distinction between the two. Similarly, if the net profit after tax is higher in the initial years, or if it is higher in the subsequent years, it does not distinguish between them. It treats both at the same level while calculating the average. So that is the biggest limitations of this method. It also does not consider the cash flow, it only considers the net profits. Hence some of the decisions may be misleading, because profit is not same as cash flow. So for calculating any project returns or returns on any investment, one should always consider the cash flow, not only the profits. Now another limitation is that it does not adjust for the risk to long term forecast. So it only considers the net profit after tax. It does not take into consideration the required rate of return by the management or by the shareholders on that investment. So it ignores that and simply makes an accounting profit after tax divided by the average investment. However, the usefulness of this method is that it is very simple to calculate, and for small projects it can be used very conveniently by the top management. And the simple thumb rule is that if ARR is higher than the required rate of return on investment, the project is acceptable to implement. And what is the required rate of return on investment is basically the benchmark rate or threshold rate at which the company would like to earn a minimum return on its investment. So if ARR is higher than that return, then project should be accepted to go ahead. And if ARR is lower than that threshold limit, then project should not be pursued and it should be rejected. Thank you. I have created some more videos related to financial management and statistical concepts. So if you would like to refer to those, you can see my channel. And if you like this video, you can forward to your friends. Thank you. Bye.